We'll be talking mainly about impact investors. And impact investors are looking for financial return, but they are intentionally also seeking a social or environmental return. And they're measuring that return. They're not just assuming that they're going to achieve it. All right, so this investment life cycle will become more and more familiar to you as you start to think about raising different types of funding outside of donor. So if you think seed ideation, looking in that column, you're coming to an investor and you're saying, I have a fantastic idea, back me. Who is going to do that? Well, your friends, fools, and family. So those are the 3 Fs, of which if you're lucky, that is where your funding is going to come from. It is not an easy phase to be in. There's not a lot of support out there. Saying that, there are multiple incubators, both privately and funded through governments. Ingenie is one of those. And if you receive those videos, you will have an idea of the way that they work. You get angel investors, you get philanthropic and foundation investors, often high net worth individuals, and they're willing to take a punt on new ideas. When you move into kind of from seed to early, this pre-profit kind of phase, you do have a market, you do have customers, but you aren't breaking even yet, or you're starting to break even. You move into a different type of investor group. You have SME or enterprise supply development funds, VC, venture capital funds, development finance institutions like the DBSA or the IDC might fill this gap. And then finally, when you're expanding, you can go to the larger, more commercially focused investors like banks, like private equity funds, fixed income funds. I mentioned the investor video examples. I'd love to get from a show of hands, who of you guys managed to watch those? I would encourage you to do so. What those investors do is give you an idea of what they are looking for in an organization in terms of the diligence that they perform on an organization, and what type of sort of size of funding, type of funding instruments that they use to be able to support organizations. And usually there's a pattern when it comes to the types of instruments that are used at in different phases. All right, this is kind of a little bit of a laundry list of funders in each kind of category. You'll see from this diagram, those that are highlighted are those that are mentioned directly by organizations, during this 2-hour session. I'm going to give you an idea of some of the regulation governing these types of investors. So incubators are relatively unrestricted in who and what they fund. Their funding is usually grant funding. Philanthropists, quite interestingly, there's a phenomenon now with philanthropy where they're not necessarily just donating money, but quite often you will get an organization or individual that wants to deeply engage with the organization that they're supporting in terms of providing strategic and operational support, providing networks and access to market. International funders, you'll usually find they each have their own impact mandate. So if you're aligned with that mandate, there are great organizations to raise large amounts of money from. The local foundation environment is predominantly corporate. And corporate foundations are governed by the Black Economic Empowerment legislation. And I'm going to describe 2 pots of funding that can be raised from corporate foundations. The first is CSI funding. The Trialogue Handbook goes into great detail about this pot of funding. It's essentially grant funding, and there's about 10 billion available, about 70% of which is actually going to education at the moment. And that represents 1% of net profit after tax of all the corporates in South Africa. The second amount is more interesting, I think, and has recently kind of come online, so to speak. These are the community trusts, or the trusts that have emanated from the broad-based ownership schemes, such as Tutua, the Standard Bank's broad-based ownership scheme. Essentially, the endowment is made up of stock from that corporate. And what these organizations do is they distribute the dividend, in other words, the earnings from that company over the period of a year. And so the funding is less restricted than the CSI funding. The column there under SME funds, and I'm going to specifically mention enterprise supply and development funds. This is a South African name, kind of terminology. Again, it's BEE regulated. Corporates are required to contribute 3% of their net profit after tax, which is billions, into these supplier and development enterprises. And they don't expect very much in return. Nevertheless, they do expect a return. So these are investment funds, and I would encourage you to go and listen to Evan on the video when he talks about Inyosi. And then finally, looking at impact funds and private equity, these are much larger organizations. The likelihood is you're not going to these organizations yet, although Mark, for example, will be talking about his engagement with PSG. Okay, so let's talk about investment instruments. You know what a grant is. Many of you will know what a loan is, a fixed income product. In other words, you receive an amount of funding as an enterprise. You are required to pay a set amount of interest every month over the course of the loan. And at the end of that period, you pay the principal back. Quite simple. An equity investment is when an investor gives you money in return for a percentage share in your company. In other words, they own a percentage of the company, and the way that they would receive a return on their investment is dependent on how well the company does. So, in other words, the better the company does, the more their portion of that company appreciates in value. And when they're able to sell that either back to the entrepreneur or to a follow-on investor, that is how they achieve their return. Now, you can imagine that these kinds of instruments aren't actually appropriate for all circumstances. And we'll hear from a number of the case studies today how these are being reimagined to be able to better match money to enterprise. And I'm going to give you a couple of examples. The first there, let's talk about royalty-based lending. So we talked about a debt investment having a set interest rate over the course of the term. Now, with a revenue-based or a royalty-based loan, that interest rate or that monthly amount that needs to be paid back is not set in stone. It's based on the amount of revenue that the company is earning over that period of time. So if the company earns more than what they're expecting to, they pay a greater a greater amount over to the investor. If they don't earn anything or they earn less, then they're not required to pay that over. The second there, let's talk about a convertible loan, because Meg is going to be talking about that with Early Bird Educare. So typically, this starts out as a loan. In other words, that relatively kind of stable payback period, interest payback period. But at the end of the term of the loan, the investor has the choice to convert that into an equity portion in the company. So if they feel that the company has grown and done really well, they believe in the management team, then that loan can convert into a percentage ownership, in the company. Could I ask if everyone could please turn their sound off for now? Then maybe lastly, when we talk about redeemable equity, instead of an organization needing to, let me just mute, find a follow-on investor, they set up a contract whereby the entrepreneur is required to pay back the equity share or buy back their share at the end of the term. Okay, I'm going to talk a little bit about a few interesting phenomena that are happening in the market you've probably heard about. I know that we're running over time. Sorry, the intros were a little bit longer than usual. Let's talk about blended finance. So essentially what's happening in blended finance is you're combining different types of investors who have different risk return appetites. So for example, you have a public sector investor or a more philanthropically minded investor that's willing to take more risk and less return, combined with a commercial investor who is willing to take less risk and wants to take more return. By including the concessionary funder in the mix, i.e. the public sector or the philanthropically minded investor, you're able to attract more commercially minded investment because they're de-risking the overall transaction. So what does that mean? That sounds a bit kind of technical. For example, so the first, a concessionary investor will give a design grant. So, for example, they will work with the organization to design the business model or the initiative that it has a better chance of working and attracting money. The second is a guarantee. So that concessionary funder agrees to pay the investor if the enterprise can't, i.e. if the business concept fails, for example. A first loss is where an investor is willing to take more risk, as I mentioned in the definition, than another investor. So, for example, an equity investor is by definition taking more risk than a debt investor. And if you put those two together, and an organization is not performing as well as it should, then the debt investor would be paid out first. And then finally, when it comes to technical assistance, you have instances, especially with SME funds, where concessionary funders are willing to provide strategic and operational support to organizations to ensure that their business model works. Last point, and then I'm going to hand over to Tender, crowdfunding. Look, crowdfunding is not a huge source of capital in South Africa. I wanted to share it with you because it's a growing kind of phenomenon around the world. And crowdfunding is essentially funding that's democratized, that's sourced by you and I in the marketplace who believe in initiatives, projects, businesses, and want to be able to have be able to stretch over and touch the organizations that we're funding rather than giving it to a financial broker. And so you'll be able to read this slide in your own time. Okay, I think I'm going to hand over to Tender. I'm hoping that Megan is on the line.
I'm here. I'm going to keep my video off just because I'm traveling.
No worries. Thank you, Sue. Hey, Megan, it's wonderful to have you with us. So to everybody on the call, I'd love to welcome Megan Blair from Early Bird Educare. Megan is a former teacher and a Fulbright scholar where she focused on education policy. Meg's got an interesting perspective as she brings both a practical and theoretical lens to the organization that she now heads. So Megan, I don't want to steal your thunder, so I want to hand it over to you to give us an overview and an introduction to Early Bird Educare. Tell us about your business.
Great, thanks so much, Jatender. So Early Bird is a social enterprise, and we have two legal entities, a for-profit entity called Early Bird Educare at Work and a non-profit entity called Blue Door. And the for-profit entity opens up educare centers serving kids from 3 months of age to 5 years at large companies. So some of our clients include Siemens, RMB, ABSA, and FMB. And we open up educare centers on site on their campuses to try and assist with attraction of talented employees and retention, particularly of moms. Post-maternity leave attrition is a really large issue in the HR world. So providing support to working parents by having on-site educare facilities is something that a lot of these large companies have included as part of their employee wellness offering. So we serve those companies. So in that sense, it's a B2B offering. But then we also partner with other forms of corporates, which are corporate property developers. So they work in commercial property developments. And again, I apologize for the background noise, commercial property developments and large scale residential property developments. So housing estates, where there are a large number of new houses being developed. And, for example, some of the areas we're working out towards the West Rand in Gauteng and up the North Coast in Cape Town, there's these new developments being built and new roads being built as the developments are coming into place. So there aren't any existing schools, clinics, etc. there. So we provide educare services for these corporate developers within their developments. So again, there's a partnership. So with the corporate companies, the companies who we're serving their employees, they subsidize us via an implicit rent subsidy because we're on site on their campus and they don't charge us rent. And with the property developers, it's more of a direct subsidy through a decreased rental payment and support for construction of the centers. So either way, it sort of leverages some partnerships. So it's not a traditional suburban preschool model. And we make money off those centers, and we use the money that we make of those centers to cross-subsidize provision of the same high-quality education model. So all IP is cross-subsidized free of charge to our Blue Door social franchisees. And those centers exist in low-income communities and social housing developments. So I'll stop there, but there's a lot to it in terms of the specifics of our thinking about how to ensure quality at scale, how to really use the evidence that exists about specifically emergent literacy in a multilingual context. That sort of we consider to be comparative advantages, particularly of our education offering. So it's not really just the business model that's innovative. It's certainly the core product is there as well.
Megan, I'm curious to understand from you, I mean, you mentioned that you've got a for-profit and a not-for-profit social enterprise side. I'm curious to understand, I mean, I know the point of this conversation is we're talking about funding along the funding value chain, and thinking about the different types of funding you seek as the business develops. When you started out, did you know you were going to have a for-profit and not-for-profit arm, or did that kind of evolve and develop over time? Because I think that also informs your funding decision and where you seek funding. So would love to hear how you guys thought about that.
That's a great question. Yeah, so we started off as idealistic nonprofit, and our model was based off of a couple of models that have been quite successful in East Africa in terms of leveraging economies of scale to be able to provide high quality service at lower cost. And so we based our entire nonprofit model off the fact that it was essentially just going to be break even. So we were focusing on servicing the two lowest income quintiles in the socioeconomic spectrum in South Africa. And our almost entire model was premised on the fact that the DSD per child subsidy, which currently is given to qualifying educare centers who serve families where the household earns less than 4,000 Rand, we were sort of assuming that would be increasing fairly soon, since 2010 has been at 15 Rand per child per day, and still we were doing our sort of calcs in about 2015, and we're like, any minute now it's going to increase, and we had sort of on good authority that was going to increase, and all our models were based on this subsidy from government increasing, which, you know, cautionary tale, don't rely on that too much. So yeah, when we eventually pitched to Innovation Edge for some grant funding, they said to us, look, we have it on good authority that's not coming anytime soon. And you can't base your entire model off that. So you need an alternative revenue stream. So then they came on as an investor rather than a grant funder. And the prerequisite of obviously bringing them on was to fund a nonprofit entity, a for-profit entity in addition to the nonprofit entity. And that was kind of an interesting process for what it's worth. You know, we had to kind of decide whether we were going to go the route of giving the nonprofit entity shares in the for-profit entity, which eventually we chose not to do because, you know, we didn't want to have to pay out dividends to all shareholders whenever we paid out to the nonprofit entity. And I know you can do pref shares, but it became overly complex. So we chose not to give the nonprofit entity shares in the for-profit, but we chose to write into the memorandum of incorporation of the for-profit entity an undertaking to cross-subsidize a set proportion of net profit after tax from the for-profit entity into the nonprofit entity. And then there's also a shared governance structure. So the boards of both entities are the same. They mirror one another. So yeah, that was kind of a learning curve, is moving from just this nonprofit world, which is how I would have loved to work. I would have loved to focus entirely on the bottom 2 quintiles of the market, but we've landed up having to serve the top 2 quintiles of the market in kind of a Robin Hood style in order to get done what we need to do.
No, absolutely. I mean, that makes sense. And I guess it links a little bit into the next question. And I think that journey is one that I think a lot of organizations, think about and grapple with, because it really does, your structure does impact and influence the kind of funding you're able to access, but it also then, how do you make sure you're staying true to mission, but still kind of being able to tap into new and different funding sources. I guess the next question, just linked to what you were talking about now, is, you spoke a little bit about raising grant funding from Innovation Edge, and then moving, Innovation Edge kind of not being grant funding, but being more seed. So we kind of skipped the grant funding question, but really talking about the process that you guys as an organization considered in looking for seed funding, and the type of terms that they as an investor were asking you for, and was it things that you were that were known to you, or was it like quite a new space to be engaging and negotiating in?
Again, these are fantastic questions, because just to briefly touch base on the seed and grant funding, that is what I think of very much now looking back on, I wasn't aware of it at the time because I never did an MBA. I was like, I just need to know about early education and then I'll start an organization. And I didn't have a ton of business skills. So now I know that was the R&D phase of our sort of business ramp up cycle. And so during that R&D phase where we were really developing some of the components of our model that drive our core quality and drive our child impacts, which is essentially our teacher support tool, which is tablet based, and our school management systems, attendance, incident reports. You need to tell parents how many times you changed a nappy in a day. There are a ton of systems. And so we were developing all of those, and a lot of that development, about 75% of that development happened through grant funding, and it was a series of sources of grant funding. Started off with prizes, and then we kind of went on a big barnstorming tour of the US through a couple of contacts that I had from my graduate school experience over there, and got a couple of, one in particular, quite wealthy philanthropist who was a sort of a friend of a friend contact. So exactly as Sue was referring to it, just those early angel types who just believe in you for whatever reason. And again, kind of trying to leverage some sense of privilege through your, social networks. So I think back on this and think it's not easy to start a business, and, networks are important. And I think that this is something that funders, I'm sure, are aware of, but even could do probably a little bit more awareness around is, I happen to be lucky to have gotten that scholarship to go overseas and get some, really wealthy people in my networks. And so that worked out, but it was a lot of chance along the way in those early days, as is often the case, as we know from the stats from how few early startups succeed. So that was that phase. And that was, in hindsight, really fun, working on, the development of what is now our tablet-based app that's really like a successful part of our model in terms of helping teachers, has all these just-in-time pedagogical prompts. I always get accused of delving too much into the education stuff because that's the part I like, but you can see more about it on our website. But yeah, so that technology is really cool, and that helps us to actually ensure that we maintain quality at scale. So that was, we were sort of working on that front. And then by the time we got around to approaching the Innovation Edge, they were probably the sixth funder we were looking at to provide some donor funding. So the other five had been like relatively small, in the hundreds of thousands each. And then we were looking to Innovation Edge to help us kind of fund a set of 12 pilot sites. And that's when they said to us, as I already relayed, no, we're not doing that. You guys, your model is based on assumptions that we don't think will hold in terms of the subsidy. But they did like what we had in terms of the product and in terms of how the level of depth of thought we'd put into scale and maintain and systems for quality at scale. And so they said, look, you guys need to open a few doors. All of your stuff is sort of the components. It's like having you're bringing us tires of a car and some car doors and a steering wheel. Let's put this thing together, open some doors on centers, and then we'll talk. Then we'll introduce you to some of the larger funders in our network. So they helped us, and they pushed us towards this for-profit entity, as I've already said. And then we started to open centers, and we opened 2 Blue Door sites in Kailicha, and we opened 2 early bird sites. And then over the course of that time, we sort of started to diversify the early bird model, the for-profit model, and realize, as I said in my introduction, that there's some market amongst property developers and not just large companies, because we don't have a ton of large companies in South Africa. So, and I mean, we've definitely pivoted even further towards the the property developer partnerships post-COVID because, changing all of work, et cetera, people aren't spending as much time at the office.
Yeah.
So
absolutely.
does that kind of answer your question about the seed and early? It was a bit of a rambling answer.
No. I think it does. I think it does answer the question, and I think what you've articulated really well is the even just the change your organization has gone through and the things you've had to consider as you moved through these different funding rounds, and then not pivoting your model in order to access a new consumer base that you actually hadn't thought about initially. And so it feels like with these funders, as you've gone from round to round, it's kind of a journey and a partnership.
Absolutely.
I think the last thing just wanted to pick your brain on is kind of your third round of funding, so kind of late early stage, and the amazing round that you've closed with DG Murray Trust and UBS Optimus, and so congratulations, because that's not an easy feat. And so, you know, to get them both and a convertible loan, and that's, you know, kind of moving up that evolution curve. Can you talk to us a little bit about how these two investors have operated kind of differently from Innovation Edge, and the journey you followed there?
Yeah, absolutely. And just to sort of pick up off of what you were saying in the early part of your question, like something that I found particularly difficult as a first-time founder, especially without a strong business background, was you hear, I'm like addicted to startup podcasts. I listen to tons of them, and so many of them say, okay, you know, to be a good founder, what you need to have is persistence. Like things are just going to get so hard, and you just have grit, just persist. And then they often also say the other like perennial piece of advice is, pivot. You need to be flexible. Pivot when you need to pivot when you need to pivot. And I was just constantly like, which one is it? Do I stick to my model? Am I persistent, or do I pivot? So it's really hard along the way. I mean, I highly recommend some like decision making under uncertainty frameworks and skills. There are a lot of great resources there to help, like with scenario analyses and things like this. And definitely delving into having investing in a lot of time into a really, really robust projections model so that we could look through different scenarios whenever, a different suggestion was made or strategic opportunity arose, was incredibly helpful along the way. But it was hard won, and there was a lot of, I think the uncertainty is a large part of the difficulty in moving through these early phases, because exactly what you allude to, you don't want to be selling out, but you also don't want to be so stubborn that you aren't moving and taking advantage of opportunities. So that was very much the sort of like heart-wrenching. In fact, I do think of like the R&D phase as being fun, and then the sort of early stage. So once we got beyond seed, it got pretty heart-wrenching because it was these constant decisions and opening centers and opportunities arising, and having to make decisions about allocation of scarce capital, because obviously each educare center you open is like a pretty capital intensive decision. And so that was actually, at least in my personal experience, the really difficult phase was that sort of proof of concept seed phase for us. And in fact, that's why we structured the deal we did with the way we did with DGMT, because we at that point had 3 early bird and 2 Blue Door sites open, and we had the social housing opportunity for Blue Door on the horizon with some partnerships in the pipeline, and we had more of the property developer partnerships on the early bird site, but we basically just had forecasts for how those sites were going to function. I mean, we had like fairly advanced leases negotiated with them and so on. So we had like a pretty high degree of confidence in our numbers, but still like for example, in our case, the key variable that drives our bottom line is the period that it takes us to ramp up from opening doors on a center to full enrollment. And that's a fairly unknown quantity. And while of course you can run scenarios and model that to some extent, you can't know for sure. And DGMT was feeling, with the sort of small handful of centers we had open, that it wasn't sufficient data to give them confidence that like this was a model that could really scale and could take into growth phase. So in order to try and give them some solace and to help de-risk the investment for them, we said, okay, we need roughly 15 million to reach profitability, our run rate profitability, and that's what we're raising in this round. But let's start with 3.5 from you guys to help us open another 2 centers. And then in that time, that can be in the form of a convertible loan. And if we are able to raise additional capital from another investor, that firstly helps you guys because it de-risks your investment because there's a second investor coming in. And if in that time we meet certain enrollment goals, milestones, which were, basically essentially if we validate our projections model, then you'll kick in the other 3.5 million and your existing 3.5 will convert to equity. So it's a little different to the scenario Sue described, where it actually wasn't a conversion option that DGMT was offered. It was a conversion trigger. So it was saying, if we meet these criteria, that 3.5 will automatically convert to equity at the same price as whatever the future investor is that invests. So given that we'd structured the deal that way with DGMT, and then that gave their investment committee some solace, and it certainly did de-risk their investment on 2 fronts. One being a lower amount and some criteria requirements or performance requirements on our part, but secondly just by virtue of it being debt, which Sue already touched on. Debt is less risky than equity because of liquidation preferences. So that was great. We closed the 3.5, and then basically the gauntlet was laid down. Like, we got to go raise another 8 million from another investor, because if we get the other 8, DGMT will kick in another 3.5, and their initial 3.5 will convert to equity. We won't have to pay it back in the form of debt, which helps us, because we'd like to rather have them recoup their investment, not by us repaying the capital, but by them unselling at a later stage when we get into, to a future investor when we're really growing, which will still remains to be seen if that can be achieved. But so that was sort of why we structured it the way we did. And actually COVID threw a huge spanner in the works with that as well, because we had to close down our centers for 4 months, and we didn't quite get as much data as we wanted to be able to give DGMT the comfort that they needed. But we were able to give them comfort in other ways by kind of showing them a couple of contracts in our pipeline that we'd managed to conclude during lockdown. There was actually it was a lot easier to have meetings in lockdown, and because we weren't running schools, my time preferences kind of shifted, and so we were able to really shore up our pipeline, and that gave DGMT sufficient confidence, and I guess also just their magnanimity in like noting that there was very little we could do about the fact that we'd had schools closed down, and the fact that they didn't have as much data as they would have ideally liked. So they ultimately, bringing on the second investor, which was UBS, and having a stronger pipeline was sufficient for them to say, okay, we'll override the initial trigger. So we actually had to process an amendment to that agreement, which is something I think is worth noting, that if you have a good fit with your shareholder or your funder, I think that I underestimated the ability to really they sit on your board, they see every single decision that gets made. You have to, you have to trust that if they're really, in it to back you, that they will pivot as well if need be. But I guess assessing that is quite hard, but in their case, props to them, because they were really made the right decision for the business, which ultimately benefits them, of course.
Yeah, absolutely. And that, I mean, that's such an important point that you've raised, though, that it's so important, irrespective of where on the investment cycle you're raising money. Strong alignment and fit with your investor or funder is so critical, because things don't always work out the way we've hoped or we've modeled or we've projected, and so the ability to flex and pivot without creating more work. And I think, Sue mentioned the outcomes fund mechanisms, and I think part of why those are successful is people, the ability to say, here is an objective or a task that you're being measured on, so we can pivot around that. I know we're running out of time. I did have one other question I wanted to ask you, just around the due diligence process, but maybe if we've got time later, we can always pick that up with you later, and just how you think about, because it's such a scary word, due diligence, but I know we've run out of time, so maybe we'll pick that up with you later. But thank you so much.
I've actually got to catch a flight, so I'll just give you literally 30 seconds on due diligence, which is my advice to anyone would be very, very clear with your funder upfront about what their DD process is. Just you feel like you have such a power imbalance when you're dealing with funders, but actually you do have a right as the potential investee to ask for, real clarity around steps and timelines in the DD process, so that you know what to expect. It really, I felt I should have asserted myself better on that front. It would have helped prep us better. But this has been awesome, Tatena. Thanks for the really thoughtful questions.
No, thank you so much, and have a safe flight.
Thanks. Cheers.
Thanks. Bye. Thank you for joining. Bye.
Bye.
So without further ado, Mark, are you with us? If you can turn your...
Yes, I am. I assume I'm the Mark.
You are. You're very... Thank you for making the time to join us today.
No, it's a pleasure.
For those who don't know, Mark is the founder and director of Shuttleworth. He has a... I'm glad that this is your first line of your bio, because it means I have to read it. You have a PhD in nuclear physics.
There must be. I really need to update.
Rocket scientist. You founded the Free State, the Free High School Science Texts Project back in 2002. I think that's where you cut your teeth in this area, and really formed the foundation on which Shuttleworth is built today. So I'm going to, as we kick off, Mark, if you could just describe your business model and your impact model.
Sure. Okay, so Siyavula Education, so we're a for-profit entity, a small edtech company based in Cape Town. As a company, we formed in 2012 on the back of openly licensed open educational resources for maths and science in high school. So those are resources under an open copyright license that were vetted by the Department of Basic Education, and a subset of them were printed and distributed to all government schools in the country by the Department of Basic Education. There's no commercial aspect to that relationship at all. All of those resources were sponsored, and we did cost recovery on the exercise, but the government took them under the open license and leveraged that to print them, and they could in principle, save a substantial amount of money in doing so. So what Siyavula did on the back of that, our books being printed and distributed to schools, was to look as an education technology company at how we can, what's the optimal complement to books being available. And we said, applied obviously a technology lens to that, and we built an adaptive practice service to complement the book. So if you've got a maths or a science textbook, then one of the best things that you can do to complement that is to practice for mastery, which is something you can do going through a proper sequence of based on research of component skills and application of combinations of component skills then to different contexts, etc. Going through that learning sequence, you can do that on paper, but practicing for mastery is more effective if you get immediate feedback, if you get problems at your level, and the problems are interleaved. And that's something that it's very difficult to do in a paper-based context, especially if you've got 30 or 40 kids in a class. But that's the kind of thing that technology lends itself to. So we built an adaptive practice service for high school maths and physical sciences that complements the textbooks that the government had printed. And we started to sell that as a software as a service offering initially, and we've pivoted a few times. So at the moment, the heart of our learning product is this adaptive practice service with a machine learning algorithm and generative question items that we've been building for the last 8 years. And then wrapped around that, we've been building out a teacher toolkit based on those resources to really interface with schools. So we sell that product to high-end schools. And then we also work with a lot of funders currently. So 40% of our revenue comes from private schools. 60% of our revenue actually comes from grant funding, where funders are making those resources accessible and available to various schools or in other kind of project-driven work. So the learning theory of change is that if students practice for mastery, it will improve their math and science results. We've done impact analyses. That's validated. What we really need to do is figure out how to get that integrated into the school system at scale in a way that's sustainable and cost effective, sustainable for us, sustainable for the school system, cost effective, so that we can continue to build out that product. So the learning impact we've tested, it's there, but we are still refining how to take our revenue from a small amount of revenue from private schools and scale that up, trying to build out some sort of offering that we can actually take to a much larger base, generate more revenue, but at a lower price point.
Yeah, really interesting how your income streams from a kind of a middle or upper income and a lower income are differentiated. You've and you're able to serve both segments as a result of thinking intentionally about how you fund each of those segments. Which is more than simply cross-subsidization. So that's interesting. My second question revolves around the Shuttleworth grant that you received in 2012. Can you describe how that grant was distributed? Because it's actually quite unusual. And the benefit and challenge from this funding.
Yeah, so the Shuttleworth Foundation I think most people have probably heard of Mark Shuttleworth. His foundation used to operate out of South Africa, and they used to fund projects, and they focused on open source software and education initially. And there was frustration within the foundation about how to make those projects sustainable. And at one point, they completely overhauled their model from giving grants and funding their own internal projects to looking for fellows. Where the ideal fellow, as described, was someone who had a really great project that they were working on in the evenings, on the weekends, where that project obviously in line with their vision and mission, that project would really benefit from its founder working on it full time. And so the Shuttleworth Foundation Fellowship's first primary thing was to give essentially an early stage entrepreneur a full-time salary to work on their project, year-to-year funding up to 3 years. And that should just unlock a whole lot of other benefits, but they're 100% committed. And so it was really important to Mark Shuttleworth that the fellows be demonstrating an earnest commitment to their projects. Rather than hiring an external project manager just to do it as their day job, you're looking for people who are already making sacrifices. They've really got skin in the game. And so that was the model was the Shuttleworth Foundation fellow gets a salary, and a travel budget. And there's some constraints around the travel budget, just in terms of what that money can be used for. And then there's a co-investment model to it. So if the Shuttleworth Foundation fellow commits a portion of their salary budget to the project, they can ask the Shuttleworth Foundation to match those funds 10, 15, or 20 times over, depending on certain criteria. And there was actually, I think it's changed now, but when I started out, the multiplier went up. The more you sacrificed your salary, the more you could ask the foundation to commit. So the first 100,000 Rand you committed from your salary, they would match 10 times over. The next 50,000, they would match 15 times over. So just with that, there was sort of, you've given somebody a full-time salary to work on a project they're already working on, and they can get about 1.9 million Rand in project funds. And you sort of were looking at at the time, about 150,000 Rands worth of travel budget. And that was, so that's quite a nice model. And it was the Shuttleworth Foundation runs it in a very lightweight way. So it's a very kind of agile organization where the requests for matching funds were restricted to sort of 4-page write-ups. You weren't allowed to write more than that. So you could actually allocate funds very quickly and be quite agile and really do experiments as part of that process. So that, I think it's a very interesting model, and they're still doing it now. They've been doing it for 12 years, I think. That exact form, they've tweaked it a little bit, but they're now just no longer based in South Africa, but with fellows operating all over the world doing all sorts of interesting things.
I'm going to jump now from Mark to public sector. Grace mentioned in the previous segment around forming a partnership with DBE and how one can tap into different funding streams within that government department. I mean, you've mentioned in previous conversation we've had that you'd very much like to work with public sector schools. I wonder if there's some of the challenges and how you've created opportunities for government to co-invest or public schools to participate?
Sure. So we definitely want to work with government schools. That's part of our mission. If we can't do that, we're not going to achieve the scale of impact that we're looking to achieve. So we see ourselves very much as a social enterprise. And one thing I just want to mention is we spun out of the Shuttleworth Foundation essentially we were initially a project. We chose to go the for-profit route so that we could raise capital to build a product. We had enough capital to invest in product development, which is something that it's very difficult, certainly in a South African context, for non-profit entities to do. To raise funds, grant funds for product development, I think is a lot harder. So we did that initially, and PSG was our first investor on that. In trying to do business with private schools, it's relatively straightforward. The school makes a purchasing decision, passes that on to the parents, and they'll pay in. With the government schools, you can either try to talk to the National Ministry about procurement, you can talk to the provinces about procurement, the districts about procurement, or the schools themselves. So we've had no love.
Cool.
Sorry, I dropped.
I think
it's something funny happened there. Can you hear me?
Got you back.
Cool. So yeah, so we haven't had any success with any of those instances other than working with high-end government schools where they would ask the parents to pay in, which is why we're looking to differentiate our model so that we can drive the price point down so that schools are likely to be able to purchase our products, our toolkits within a school budget rather than having to ask the parents to pay in a large sum of money. With with all of the other instances, the districts, the provinces, or national, there isn't a clear procurement policy around the vetting and procurement of digital products. There's no actual budget specifically made available to schools for that. So that's why you have to get the schools to pay in, or you need to drop the price point to the point where it's almost within departmental discretionary budgets that they can procure. Does that answer your question?
It does. I wonder if you can talk a little bit about the sponsorship model. Again, someone sort of recommended that in the Math Centre case study, and how that worked.
So we spun out trying to get as far away from grant funding as possible and raise private equity. But the thing that's kept us going for the last 12 years has been, 8 years has been grant funding. So initially what we were working on was the sponsorship for the development of openly licensed textbooks, and we got far more efficient at that, and we built our own technical tools for streamlining that process, and we could introduce margin in that, which we then used to slowly build out the adaptive practice service in the early days. That we stopped doing any textbook work in 2014 when the government announced that they were going to have one textbook for the whole country. That policy didn't really get implemented, but it confused the situation enough that all of our funders wanted to know if they were either sponsoring state publishing or if they were going to sponsor textbooks that were never going to be used. And it was just too complex to navigate at the time. So we switched. And what we decided then to do was work with funders around making our teacher toolkit, our adaptive practice service, either available to schools or to the province to allocate to schools. And now we've actually transitioned to a brand sponsorship, making our practice product free for all learners. So for grades 10, 11, and 12, it's currently sponsored by MTN. And so they see that as a kind of a marketing and CSI opportunity where they get a lot of brand exposure, but they're having social impact. And that allows us to offer the product to learners for free and still have that alongside the commercial offering where we're selling to high-end schools and still trying to figure out the pricing structure for kind of lower-end schools so that we can do business with schools directly. And so we get about 60% of our revenue from grant funding in total currently, and the grant funding has had a diverse set of projects over the years that we've worked on. So we've done everything from large-scale experiments, just trying to attract individuals through online marketing, advertising, things like that, and trying to drive enough engagement to show a learning impact, but then other ones where we're sponsoring schools specifically and working with the teachers as the lever to drive the engagement. So currently our best model is to say that teachers are the highest point of leverage, even with a funder. So we'll need to work with the schools directly to try to get teachers to drive engagement. If we can get certain levels of engagement with learners, we can show the learning impact.
Okay. Yeah, interesting. Now, I mean, you've mentioned quite a lot of funding relationships up to this point in the conversation. I remember you saying that one of the major investments that you attracted early on was actually through PSG, who are kind of a large asset manager who've invested in low-cost private schooling. So and were obviously believed in your model very early on. Outside of that investment and the revenue from your business, you have needed to sustain Siyavula by taking on grant funding at certain points in time. And you mentioned that quite often donor funding leads to donor-driven ideas.
Yes.
And that can maybe lead you off course. I wanted to know how you managed to maintain and sustain your core business despite having to, stay alive through taking on project funding from donors.
No, that's a good question. So, and it's very difficult to do. So there were a few years, to be brutally honest, where we didn't really make a lot of progress on the core learning offering that we were trying to develop, and our engagement with schools. So, 2014, 2015, 2016, we didn't actually make a lot of progress. We would take on almost service work as an organization, always in the maths and science and educational space, and with our technology hats on, but always trying to carve out as much capacity as we can to keep the core business going. But there have been a couple of occasions where it was definitely very tight, touch and go. We did get in another round. Our initial investment in 2012 was from PSG. So they don't typically invest in startups, as you mentioned. They're Kuro, Capitec, more their scene. But we also received an equity investment from the Omidyar network at the time. Now they spun out their education offerings as Imaginable Futures, I think, sort of in the last year or so. So you might have heard of them as ON, Omidyar Network. They're now Imaginable Futures. So the only thing we were actually able to do was to keep focused on the maths and science nature of our work, and trying to work our platform into as many of the grants as possible. But there were times when we did almost teacher training on, digital products or tools like that for a little while. So I think our initial hypothesis that we're more likely to be able to continue to focus on our product development if we raise equity and we invest that. I think that was validated. We managed to stay alive in difficult times with grant funding. And then the thing that was almost a transition for us was when our grant funding projects then again aligned with what our core product was, the teacher toolkit, working in schools, using that to drive learner engagement. And so over the time when we were doing grant projects, we did have thousands and thousands of learners using the platform, so hundreds of thousands of learners, and we managed to collect data. And so the one piece that did continue during that time was collecting data, doing an impact analysis, showing that we can't use just individuals and social media to drive engagement, but having that impact data to convince a funder that actually if we can just get learners to use the platform properly, we can show that their marks will improve. And so subsequently, we've now done sort of 3 iterations of impact analysis. The results all validate, they're in different segments, and in that we've used teachers as the lever. So we've got a really compelling case now with data to back it up, that working in schools, teachers as the lever, is the way to go. And that's brought our core product in line with what funders that want to work with us are prepared to align with. So it took a while. There were a few years where we were working on very different things, basically doing service work, but we brought it back together. And I think it was the data and impact analysis, having the core product out and built, that allowed us to collect that data and use that data to slowly motivate and bring all of our projects back in line with the core offering. But yeah, it took 3 years or so.
Last question, because I know that you have to go. You've mentioned data. You've mentioned using it to be able to compel, funders or build a case for the impact of your product and your service. How else do you envisage being able to use this data? Because you seem to be collecting a significant amount of really valuable data in the area. So
I think we've actually got a prototype of most of the chain in place now for using that data. So one of the things that we realized working with schools is just, it's not new to anyone, but the maturity of our education technology sector, it's a relatively immature sector. So if you dropped an adaptive learning maths product into a Norwegian school, they would use it and it would just feed into all of their reporting. They would all be able to handle the data, etc. When we operate in a school, we actually have to work with the full chain of stakeholders around the reporting, what data they need, how that data is going to get fed to them, because teachers have got no means of taking the data that we're giving them and reporting on it, and their HODs don't know how to consume it, and their district officials, the subject specialists at the district level, don't know how to consume it, etc. So what we've actually built is something where, starting with, every time a learner does a question, we track that. We know what the question was. We know how long they took, what type of device, whether they got it right or wrong, what answer they saw, whether they moved on to another question, etc. And we just aggregate that. So we aggregate that data based on our impact analyses. We've got a strong correlation between the mastery we calculate for a student and the results they actually get. So we can tell them, this is your master. We give them a dashboard where they can actually see the mastery of the topics that they've been working on. And that's an accurate reflection of their likely performance. And so that's the first place we use the data. Then we re-aggregate that now at the class level for the teacher. So there's a teacher dashboard that gets populated automatically with all of that information. And we've been working to make school activity reports. So we identified the key KPIs that the school sector has got for the schools and for the district officials. And so there's a school activity report which has all of those metrics tracked automatically based on students just practicing. So no one has to intervene, no one has to record anything. We just populate all of those dashboards automatically. And we've got all of the permission structures in place so that the district officials can just log in and see their district dashboard, which is yet a further aggregation of the school KPI report, so they can see that. And then we've also provided national with, because we know what learners are practicing when, there's one big challenge that the government has is to just track curriculum delivery. And over the last 4 years, we've seen and shown a really strong correlation between what's used on our platform and what's being taught in class. Learners don't actually charge off and study some other topic. There's a really strong correlation between what they're being taught in class and what they're actually going to practice. A small number of them move ahead, etc. And so we've been actually able to provide DBE with curriculum progression plots during COVID, during lockdown, about what percentage of learners in which province have been working on reading which textbooks and doing practicing what content. And you can see that there's a small cohort that moved ahead during the start of lockdown and completed all of their work. Another cohort that moved ahead and did a slightly larger cohort and did all the second term work. And then the majority of learners just revised term one over and over again. But we pick all of that up by all the learners are doing is practicing. So it's a passive monitoring system from which we can see curriculum progression in schools, and we can slice and dice that by quintile, by district, by province, whatever. And then because we've calibrated our mastery calculations that our algorithm has with school-based results, and there's a strong correlation, we can actually use that as an internal measure of learning progression. So we can actually then, on the basis of that, give them, without them having to set a diagnostic test or special assessment, we've actually got a dashboard where we can show learning gains by province or by quintile or by grade or by usage level. And you can just, it depends how you want to slice and dice it, but we can actually compare learning gains in cohorts or by usage in a district or something like that. And all of that comes just from learners practicing on their own. So we're really excited about the fact that we can give the learners the information they need, the teachers, the district officials, and national, plus we've got the measures of learning, and we just rolled out the parent dashboards last week. So at the heart of it, a learner just practices their maths and science, and you give all the other relevant stakeholders the information they need. So I'm really excited. And then obviously the big data thing is, okay, we'll use that data to further improve the algorithm in time. But I think just giving all of the stakeholders this visibility of what's really going on is actually the most powerful thing we can do currently, given the maturity of our EdTech sector. Because a lot of district officials, when we speak to them, just want to know what's happening in a school. And to find they're responsible for 80 schools. They go to a school that they have to ask for a random sample of books that they try to assess. We've got a KPI report for them. They can see how many kids are registered, how many have been practicing. They can see the class reports, and it's all working really nicely. So I'm really excited about the data stuff, obviously.
Great, Mark, really informative, and thank you for making the time to share. I think I certainly got a lot out of it. I hope everyone else did as well. And I'm sure you might get some questions coming your way. But I'm going to leave you now to go back to your workshop. I know that you've been pulled out. So great.
Okay, cool.
Cheers. Bye.